We're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. Let's get right to it. Shana Sissel joins us, President and CEO of Banríon Capital Management. She's in Chicago, joining us via Zoom. Shana, what kind of conversations have you been having with your clients given this extreme volatility over the last several weeks here?
So my company, obviously, we focus on the alternative space. So the vast majority of our conversations have been helping advisors talk to their clients about how alternative investment strategies, specifically ones that are low to no correlation, can help in their portfolios kind of help to dampen some of the volatility and different ways in which they can use alternatives to kind of have more productive conversations with clients and help them get more comfortable with what's going on in the market, because we think that going forward that this volatility is here to stay for a while. And so it's all about having productive conversations on how to kind of address the volatility, especially for clients that are getting closer to an endpoint like retirement or something of that nature.
So people have been talking a lot about potential stagflation fears. What is data telling you is really the risk there? What are you hearing from people? And how would you advise your clients in that type of environment in terms of alternative investments?
So stagflation is a real risk. It's the idea that inflation is higher than GDP, actual economic growth. There is the potential for that to happen, especially with the tariffs. I know the Fed has said that they believe that the tariffs impact on inflation could be, quote, transitory, which using that word, I think, is a mistake. I think we've already learned that. I think that could very well lead to stagflation, because I don't think it's necessarily going to be transitory. But I also not convinced that the tariff policies that are being threatened are the tariff policies that will actually go into place. And time and time again, we've seen that with this administration. In terms of how that impacts alternatives, is we're looking at things that are, going to be able to address the volatility of portfolios. So that's things like market neutral, long, short, directional equity, hedged equity, managed futures, global macro, anything with an arbitrage aspect, anything that has a hedge. And those products have actually done quite well. We took a look at some of our partners. And so we have a number of ETF partners that we work with. And all of their products are outperforming the market substantially, with the leader in that space being an equity market neutral product, ticker symbol BTAL. Again, they're a partner of ours, but that product has done incredibly well through this. And so those are the conversations we're having. They're the easiest things to kind of implement on the fly. The private products take some time, so we're looking at quick implementation of products in order to dampen some of the volatility.
So, to the extent that alternatives do provide a non-correlated return, what's the best way to play it? Is it through the ETF market, Shana?
Right now, I think it is. So there's a number of ETFs that do hedge fund-like strategies, and ultimately those are the ones that you would want to look at. The same is true in the private markets. You want to look at hedge fund-like strategies, not necessarily private equity, private credit. Those things move in lockstep with their public counterparts, even though it's at a lag and they don't mark to market, they do have correlation there. So we're looking at, say, managed futures like a CTA, as I mentioned, BTAL. There's CBLS, which is a directional long short, MRSK, which is a options strategy using put options, so it has a hedge aspect, RDFI, which is a closed-end fund arbitrage fund. Things of that nature is what we're really focusing on. Those are the ones that have done quite well. I took a look at them last week, preparing something for our clients, and all of those products have outperformed the market, some more than others, but they are all low to no correlation. They all have a hedge, and they're all designed to help to mitigate volatility in the markets. These things hadn't been particularly popular until recently, and now we're seeing, equities and fixed income move in conjunction with each other, which is not how we build portfolios. We build portfolios thinking fixed income and equity will not move in the same direction at the same time, but that's not what we're seeing. And that actually makes what the Fed decides to do in May all that much more important, because the Treasury market, I think, is more concerning, and the rates going up with Treasury yields is more concerning than, say, the equity market's volatility, because portfolios traditionally are designed with that 60-40 mix. And when both the 60 and the 40 are going down at the same time, you really need this alternative sleeve in order to kind of mitigate that volatility that you're seeing in that and kind of protect on the downside.
Yeah, it reminds us a little bit of 2022 when both stocks and bonds went south. Shana Sissel, thank you so much for joining us. We always appreciate getting a few minutes of your time talking about alternative investments here. And maybe in this type of environment, they can play a leading role here for a lot of folks out there. Shana Sissel, she's the president and CEO of Banríon Capital Management. She's out there in Chicago. If you're looking at company news today, one of the big items crossing the table is that NVIDIA